Maybe one company says we'll never buy back shares. Another company says we absolutely will buy back shares if the conditions warrant. So you can have kind of different. You can have ones that are perceived as more aggressive or more defensive, that could kind of give you some wiggle room in terms of what position you could be in the market. But where I get nervous is that long tail of companies where they're not necessarily doing a ton different, and they're not the most liquid and largest and safest, because there are liquidity network effects at play. So
Mhm.
I think there is a market to have treasury focused companies in the major capital markets of the world where regulators are fine with it. But beyond that, I think you generally want to look at companies uh, that have operations as well, or obviously just holding Bitcoin and letting that do its work.
Hey guys, welcome to Everyday Finance. People often think of the well-known four-year waves caused by the halving when discussing Bitcoin market cycles. But this time, global liquidity rather than supply shocks may be the true driver. Liquidity has already helped stocks like Nvidia and Apple reach previously unthinkable heights, and macro researcher Lyn Alden thinks Bitcoin may be about to enter a similar stage. She argued that Bitcoin is evolving beyond the traditional boom and bust paradigm in a recent interview, explaining why this cycle has perplexed both bulls and bears. It is no longer only about halvings. It is also about who holds Bitcoin, how institutions manage it, and what kind of liquidity background it sits in. Corrections may last longer but build a stronger foundation with more advanced holders. Alden sees this as consolidation ahead of a fresh growth propelled by macro liquidity, fiscal expenditure, and the same drivers that have propelled traditional markets to multi-trillion-dollar valuations. Despite the fact that 2025's price action has fallen short of the high expectations, if you enjoy in-depth, data-driven analysis, be sure to like, subscribe, and share whether you agree with Alden's long-term bullish thesis or believe this cycle is already losing momentum. This video explains why Alden believes the bull market isn't ending, but is evolving, how her outlook has changed, and what the upcoming year could mean for investors.
So I think significantly yes, but I would have some caveats. So one is like in that chart you showed, one of the challenges, of course, is that's in dollar figures. And as Bitcoin gets much larger, of course, the dollar figures for almost everything are going to increase. And if you notice, like the spikes were during major bull markets. So 2017, then 2021, and then 2024. These were kind of periods of major new highs. And what happens historically, we have kind of data of this going back to like 2011, kind of every major bull cycle in Bitcoin's history, is that you get selling pressure from longer term holders when you're kind of reaching new highs and that there's plenty of liquidity to sell into. If you try to sell into a weak market, you get a lot of price slippage. If you're a meaningful whale, and you're trying to sell, you generally want to sell into a bull market, to kind of sell, and your coins are easily bought by new buyers. Um, I do think that the narrative like the IPO is correct, but it's not unique to the cycle, which is to say that there's some aspects unique to the cycle, but basically you do get that kind of gradual distribution from very early adopters, much like a startup company becoming, a publicly traded, widely held entity. And basically the difference is that Bitcoin is not a security and it's always been public, but you still get that kind of same sort of investor behavior where you get, kind of super high signal early adopters, and then you get kind of people come later. They've seen more patterns of it. They've had time to kind of analyze it. They have less explosive upside potential, but also generally less risk by the time that they buy in. And one way to kind of capture this is like people that have been holding for many years are often up 5, 10 times or more, depending on how long they've been holding. It could be many times more. Many of them have, they've aged a number of years. Many of them have families that they didn't have when they started hodling. Many people want to just upgrade their consumption patterns. Some people get nervous by having what has grown to maybe 90% of their net worth or more in an asset, and they might still love the asset, but they might say, well, there's no other asset I'd even put 10% of my net worth in. I got 90% of my worth in this one. Maybe I want to go down to 50. So I'm
Yeah.
still bullish, but maybe I'm not, betting the farm anymore on one thing that could chop around and do all sorts of stuff. So you get any number of reasons that are pretty valid for people kind of distributing. Sometimes you also have someone that distributes back to themselves, which is they say, I've been self-custodying, what is like now millions of dollars, and maybe I still want to self-custody a bunch of it, but maybe I don't want to self-custody all of that. And so you get kind of potentially selling into ETFs or treasury companies that then that same individual or group continues to hold, just in a different form, which can potentially give them kind of different types of liquidity access and stuff like that. And so I do think what's different with this cycle is that you do have, I mean, obviously the ETFs and the treasury companies present new opportunities for the types of selling and distribution that can occur. But I think this is part of a broader kind of pattern that happens, and I think will continue to happen in every major bull cycle. It's kind of part of that natural distribution process, and that's also why I tend to be on the bearish side of bullish all the time, which is you people keep saying things like, it's going to be like there's going to be a shortage of coins. There's all this buying pressure, and there's so few coins on exchanges or so few coins XYZ. But the variable that always surprises people for some reason is that when you do go up multiple times, you get selling into that. And I think we've entered the phase, and we're going to continue to be in the phase where it's not new mining supply that really kind of impacts price. It's the question is, at what price can you unlock, tightly held coins or previously tightly held coins to get them circulating. And so you have all the different demand sides, liquidity, regulatory changes, perceptions of the asset, all that type of stuff is on the demand side, and the supply side is basically either, for the most part, it's older holders selling into strength and liquidity. That's the most common. And then in rare moments, you get these longer term holders selling into fear. So, for example, that kind of bottom in 2018, you had a rare OG selling into weakness moment. There are a couple of moments like that can happen as well.
The very well.
Yeah, you get kind of capitulations, but for the most part, it's older holders selling into periods of strength, and distributing the coins. Yeah, it's a good set of questions. And it's funny how fast these things can change. So a lot of this is not surprising. I guess the part that surprised me a little bit is how quickly things can change in like a few months. Back in like June, Metaplanet was touching an 8x market multiple to net asset value. And then just a handful of months later, it's like bouncing, at or around one. And so at the time, I was like, well, I wouldn't buy it at this multiple. But if it came down lower, I'd be interested. If you would have asked me at that time, will it be like one-ish in just a handful of months? I'd be like, no, I expect it to be lower, but I wouldn't have guessed that it'd be one. Maybe I'd be like two or three or 1.5 or whatever the number is. Same thing with strategy. I tend to get, whenever it's the kind of the brief times is hit like 3 times MNAV. You generally see at the same time that Twitter's like very euphoric about it, saying, why couldn't it go to 5? Why couldn't it go to 10? Why couldn't it, this is actually what the MNAV should be. And I tend to get nervous around those periods. I tend to get, more comfortable when it's like, a firmly sub 2 MNAV. But again, if you would have asked me, would it go all the way down to 1.2 ish MNAV by this point? It's kind of the go maybe quicker than I would have guessed. Even though I think that it's in a debate with Andy Constant, I mentioned that my estimate range for an appropriate MNAV is something like 1.2 to 1.8 for them. So we're kind of currently at the bottom end of that range. We could certainly go lower. My general view is that a successful treasury company, if you're a pure play, meaning you're not just a company with cash flows that happens to stack Bitcoin, I think the market for that is endless, basically.
Yep.
If you're kind of known as a treasury company and you have thin operations and the main thing you do is stack Bitcoin, generally speaking, you want to be the number one or number two in your market, depending on how big that market is. Because if you're an also ran, that gets challenging. So, and market in this phase is basically what the currency market or the capital market you operate in. Or sometimes that could be modified by a company that's willing to operate a little bit differently. Maybe one company says we'll never buy back shares. Another company says we absolutely will buy back shares if the conditions warrant. So you can have kind of different. You can have ones that are perceived as more aggressive or more defensive, that could kind of give you some wiggle room in terms of what position you could be in the market. But where I get nervous is that long tail of companies where they're not necessarily doing a ton different, and they're not the most liquid and largest and safest. because there are liquidity network effects at play. So
Hmm.
I think there is a market to have treasury focused companies in the major capital markets of the world where regulators are fine with it. But beyond that, I think you generally want to look at companies uh, that have operations as well, or obviously just holding Bitcoin and letting that do its work.
Alden's assessment of Bitcoin's price movement in 2025 is reasonable and grounded. While the market has lagged behind the more optimistic bullish predictions, she contends that this is only a pause rather than a breakdown. She claims that the previous year's largely flat movement is a reflection of a time without significant triggers rather than a sign of declining fundamentals. The nature of this correction demonstrates how dramatically the market has altered. Even though Bitcoin is in a weaker phase of its cycle that typically follows fervent rallies, the leading players today are institutions who approach Bitcoin like a typical portfolio item rather than the hysterical retail traders of 2017 or 2021. Slower price action, less severe volatility, and eventually a longer, more resilient bull market are the results of that change. And this brings her to her main point: global liquidity, the amount of capital moving through the system, and the actions of governments and central banks will determine the next significant move in Bitcoin. It's not mining mechanics or stories about a halving.
What do you think about
Well,
that?
the short answer is no. I mean, every kind of country has a certain dial where they're taxing, and then it's like, well, how much will be taxed by the working and middle class? How much will be taxed by the wealthy? There's a dials that they can adjust. Generally speaking, when you get into like unrealized gain, like taxing unrealized gains or just wealth in general, you get into a lot of issues. Kind of like how income tax, the trouble with it is it makes you have to surveil everyone's income. And the problem with the wealth tax, you have to surveil everyone's wealth. And you start to, depending on how much you dial it up, you start to give an incentive for entities to leave. And the more attractive the location is, the more likely they're willing to put up with some of this type of things.
Hmm.
And also, the more onerous the exit policies are.
Hmm.
People kind of do the cost benefit analysis, which risks a area getting into that trap where not a lot of people want to be there, but you're kind of relying on traps and force to keep capital there.
Yep.
Um, and I obviously I would disagree that Bitcoin is unproductive wealth, and it's not luxury wealth. It's categorically different.
Hmm.
Um, and I think one of the things we've talked about a lot in the Bitcoin space is when you do monetize things of utility, that actually ends up being destructive. If you store your wealth in extra real estate, for example, you drive up the real estate prices of people who just want it to live in.
Hmm.
Things that are they're basically treating it like a consumer durable, the most important consumer durable that someone has, the shelter around themselves and their family. And so if you drive that up, because if money's weak, and Jeff Booth has made this point, if money's weak, people use, it monetizes other things, and people look out for things that are scarce. And they monetize that instead. So if money's weak, they monetize real estate, and they try to attach a fiat currency short to it. I would say that's unproductive. It's good to have a productive, like as a non-utility or low utility store value. Something like gold, where 90+% of it is mostly store value or display of value, and a very small percentage of its of its use is for high industry. And Bitcoin's in a even more focused boat, which is that it's almost entirely a monetary good. Now, it does have these database attributes that are obviously controversial at times. You can do there are non-monetary things you can do with Bitcoin, but the vast majority of its use case is monetary. And so I generally am of the view that monetizing things that are kind of designed or just happen to be have amazing monetary properties, things like gold or Bitcoin, that's the kind of the best place for society where kind of excess value could be stored until it's ready to be deployed into other things, versus quote unquote productive investments, things like storing money in utility items, therefore impacting those. A lot of these types of things, even when they have good intentions, it often just doesn't work the way people think. It's not like you think, well, I could store Bitcoin, but I'm not going to do that, and so instead I'm going to go make productive loans to small businesses or something. That's just not how That's not how capital allocation happens. And generally speaking, if there's something that they consider productive that's not getting a lot of capital, there's probably a reason for that. And so it's that kind of social engineering is hard to do correctly. I think people should be. I'll just one more point. People should expect the state to push back on this. I mean, basically, they control a centralized ledger, whether it's the U.S., whether it's the euro area, whether it's all these other places. They control a centralized. It relies on obfuscation. They want to be able to spend without necessarily taxing the same amount, so they have to kind of base people as kind of invisibly and slowly as they can, do. Um, and threats against that they don't like. When people have ownership of their own money, that can't be debased, that can be made portable, they're going to try to attack it where they can. And one of the main things they can do is through taxes. It's harder to just go out and get everyone's Bitcoin. And even taxes are not always 100% enforceable, but the more frictions they can put on it, they do start to tweak the cost benefit analysis. I mean, that's also one of Swan's missions early on was, what was it, create 10 million Bitcoiners in the US. That's why these things are important. That's also why I put a lot of work into articles and eventually a book related to the subject, which is it's not as simple as being a lone wolf that holds Bitcoin and doesn't care what happens around you, because if 99% of people think you're the bad one, or get kind of tuned into thinking, well, how dare this person store their money in a non-debasable way, we should kind of tax that unproductive wealth back or ban it or something like that, they can add considerable frictions. And so I think education is a really big part of making the lives of people easier that just want to do what's kind of what they view as a sensible thing to be doing, kind of trying to avoid debasement, save in useful things, and not kind of just pay the kind of the broader cost of bad policies elsewhere.
The core tenet of Alden's macro forecast is that everything is driven by liquidity. She anticipates a significant turning point when the Fed stops shrinking its balance sheet and gradually starts to expand again. Not a deluge like in 2020, but a sustained structural increase that subtly boosts risk assets for years. She thinks that when combined with ongoing budget deficits, this leads to a K-shaped economy in which mega-cap technology invaluable. Assets like gold and Bitcoin prosper while the overall economy falters, even while retail demand is still weak. Institutional flows are gradually restoring the bull market from the top down. Although she sees these as short-term disruptions rather than reversals, Alden warns that the coming months may be uneven due to weak consumer mood, policy uncertainty, and decreasing job growth. She contends that the long-term climate is still extremely optimistic for Bitcoin and other hard assets, because fiscal dominance keeps markets afloat, and because of potential wildcards like the Supreme Court's impending tariff decision, which might shift hundreds of billions in economic pressure. When combined with impending rate cuts, the message becomes evident. Liquidity isn't going anywhere, even though volatility may continue. According to Alden, long-term investors should focus on resilience, adjusting to changing liquidity dynamics, and setting themselves up for the next sustained run higher rather than making big 5x moves.